Our first fund was a 2011 vintage fund. We raised $21 million. We've now grown up and have a $500 million under management. You can't go around trying to invest the cheapest investments because that's not a recipe for success. You don't want to lose because you're just systematically bidding lower than every other firm. Like there's 3 founders. There's always one that's going to be gone within the first 2 years.
The growth is happening much faster. There are many ways to make money in venture.
There's lots of ways to lose money too. I think you have to be an optimist in this business. We are at just the very beginning of what will be multi-decade shift in technology.
Welcome, David. Excited to have you on this show, and thank you for doing this.
Excited, very excited to be here. Thanks.
Yeah. Well, first of all, congratulations. You, Rob, and Lee started the firm in 2010, I believe.
Yeah, started 15 years ago at this point, yeah.
15 years ago. And here you are launching or maybe deploying your 6th fund, is it?
We are currently investing our 5th fund, and maybe we'll have some news early next year.
Fantastic. So 5th, hopefully very soon going to 6th. That's a big congratulations to the 3 of you, and it's now the 5 of you. You have now expanded to New York. You've expanded to San Francisco with Stephanie and Melody. Yeah,
that's right. I mean, we've grown up from 3 of us started this the firm in Boston in 2010. Our first fund was a 2011 vintage fund. We raised $21 million in that first fund, and we've now grown up and have a $500 million under management. Currently investing out of our $135 million fund, and added Melody in our New York office about 7 years ago, and then Stephanie joined us in our San Francisco office about 3 years ago in summer 2022.
Right. So from Boston roots to now investing across the country.
We invest across the country, and that includes not just those 3 areas, but I'm on a board in Chicago and Richmond, Virginia, of all places. So we'll invest anywhere.
So I remember when the 3 of you launched the firm, you were probably the only firm doing B2C, and you personally were leading the web meetups, I remember, and you were really catalyzing the consumer ecosystem in Boston, which was sort of almost non-existent. So I think you had a huge role to play personally and as a firm in really exciting the consumer market locally. So today, just catch me up. 15 years later, how do you think about each fund split? Is it all B2C? Is it B2C plus B2B? Just.
Yeah. So what I would say is we have a theme around what we call the everyday economy. And, the theme there really is we're thinking about investing in technology, which reshapes real world industries and mass market end users. And so what I'd say is probably a third of what we do is truly consumer facing. And some of our, biggest wins have been in that category. I mean, I was a seed investor, a company called ThreadUp, which, went public, $1.3 billion valuation. We're investors in a company, Whoop, here in Boston, which is, a fitness wearables company, which actually Will just said they want to go public in the next 2 years. But probably about 2/3 of all what we do is B2B, but it's kind of B2B2C, enabling layer technologies, which help facilitate an experience, an end user experience some way. And that end user experience could be within the workplace as well. But what we tend to shy away from really is kind of selling enterprise software to CIOs somewhere, something that's too many steps far away from kind of an end user experience in some way. We've literally never invested in, I don't think, in a security company along the way, even though we've invested in 250 odd companies. So it really is about that end user, and some of that time is the end user in the consumer face, or it's an end user when they're doing kind of adopted at work as well.
Yeah. Okay. So to simplify it and shorthand it for our listeners who are founders, large end user market. If you have a large end, whether it's B2C, B2B,
whether it's in a worker or at home.
Work at home. Okay, excellent. So how does the team as a whole sort of divvy it up? Are there folks that are focused on large end user consumer market, others who are looking at B2B2C? Like, how do you guys divvy up the work internally?
When we started the firm, we intentionally wanted to create a firm that was all generalists so that we all kind of speak the same language. I was at a previous firm, and there was the IT team and the deep tech team, and then the healthcare team, and they all kind of spoke a different language. And so we wanted to have it set up so that anyone could do any new investment within the firm. As you might suspect, though, like over time, the analogy I like to use is like over time you develop a certain muscle, and when you flex that muscle, that muscle gets bigger over time. And so, I think there's different areas where each of us have spent more time. And so we kind of naturally gravitate. So like I've done a number of things, the intersection of commerce and in particular in marketing. And we can talk about my background is as a marketer. And so a lot of success that I've had here next to you has been investing in, marketing companies. I was an investor in a company called Triple Lift, which is a New York based programmatic native advertising company that got bought by Vista for $1.4 billion. Or I'm a seed investor in a company called Attentive, which is SMS marketing for e-commerce retailers. They last year said they publicly last year they said they did 500 million in revenue last year. So like the marketing stuff, like if it comes in our firm, like usually kind of people point it my way. Rob has done a number of investments within the digital health space. In Boston's investor in a company called Devoted Health. We're also investors in a company called Forum Health, which is around medical assisted weight loss. She's really done a number of consumer businesses. And so each one of us has different muscles, but like any one of us could lead any investment within our broad everyday economy theme.
So each has a muscle, but as a team, you're able to understand each other. So there's sort of
Exactly.
like I don't see it in a B2B to C company versus a B2C perspective. So you're all sort of, if the end large market is a unifying factor, then even if you're a specialist in something like, say, financial services, you're all able to speak the same language.
That's right. And my partner Lee talked about financial services. He was early PayPal, and
That's right.
the first job out of college at the PayPal. And so he, as you might suspect, he's done almost all of our financial services.
So, well, how would you say then, what is the next few brand? There's a lot of investors sort of, at the seed stage going after those similar deals between the markets that we just talked about, Boston, New York, San Francisco, and across the country. So
Yeah.
why does a founder pick you? What is that brand?
So I think a firm's brand, it starts as a blank canvas, and then over time you've earned it based on the companies you invest in. And so I think part of it is the companies we've invested in or exemplified, and kind of build upon each other. I think I think about our brand promise to entrepreneurs, and we are a completely flat partnership. There are five GPs. We have no junior investors, and what we tell entrepreneurs is you get to work directly with us. And moreover, we do probably fewer investments on a per partner basis per year than most other seed firms. And so that allows us just structurally to spend more time with our companies and with our founders. And so, when I think about kind of the models, you kind of alluded to it in seed, like there's the spray and pray models, which is way over here. And, we're way on the other side. I think you can make money both ways and in somewhere in between as well. But we very much are on this side here where each investment we're making is truly that. It is an investment, and it's a high conviction, hands-on approach. And part of that's just stems from the three founders. We were all at Series A firms prior to this. And so we kind of took that Series A lens and, brought it to seed, as opposed to, we were first starting. There was a rise of super angels, and they were just, very prolific. Like that's just not in the DNA of who we are.
That is a very important point there, and let's tease that apart a little bit.
Yeah.
There are many ways, as you said, to make money in venture, and different
Yes.
people are
There's lots of ways to lose money too, but yeah.
lots of ways to lose, lots of ways to make, and folks are deploying very different strategies. And you can have a company with multiple funds on the cap table that have completely different strategies, right? So
Yes.
So let me just back up a little bit. High conviction investor, you said something important, which is you're doing far fewer deals a year than your average early stage investor. What does that mean? So fewer checks, bigger ownership? Like what are you looking for?
Fewer checks, bigger ownership, and just higher consideration. I mean, we're probably doing, we do probably about 10 core investments annually for the firm. There's five,
So two per partner.
2 or 3 per partner.
Yeah.
And, there's no quota in this business going, for the dollars going out there. The only
For
dollars
That's right. That's right. So do you think about, look, I'm going to do 2 this year.
Yes.
Do you think that way, and you look at how many seriously to arrive at those 2?
Yeah. I mean, of course I mean, you look at dozens and dozens, and right, part of it's how you define seriously. But um, I spend a lot of time with many partners, or excuse me, many entrepreneurs each year, and yeah, I think this year, yeah, I've made two investments, and I'm excited about some of this.
You're
So.
excited. Okay, well, we'll come back to those two investments very shortly here. But just going back to sort of how you think about early stage, which is high conviction, and check sizes are what, one, two?
Yeah, so we will do both pre-seed and seed. So at the pre-seed stage, we'll invest 500,000 to 1 million, million and a half, and then at the seed stage, we'll write checks of 1.5 to $3 million in a seed round. That's $3 to $5 million. We tend to be quite syndicate friendly. Some VCs kind of have sharp elbows, and we try to be collaborative within the syndicates.
What are you seeing these days? So at the pre-seed level, sort of what are the averages you're seeing in terms of what's getting raised? How many folks are in that cap table? Similarly at the seed stage, like, what's happening in the market in your world?
In our world, I'd say pre-seed, yeah, $1.5 million total rounds. Next seed is usually writing $1 million check. That 500K is either comprised of a smaller firm doing a couple hundred grand, and then a bunch of angels, which are going to be targeted and relevant. Those tend to be pre-product, pre-everything, and I think that's a place where we're quite comfortable.
Right. And a seed is what size? And
See, there's 3 to 5 total. We'll write a $2 to $3 million check. As I said, we tend to lead or co-lead those rounds, and catalyze rounds come together. That being said, I have no ego as to whose name is at the top of the term sheet. My ego is our name on the cap table, and so we'll join rounds as well, even if we don't lead them. And those are typically one firm, writing a $2 or $3 million check, or two firms kind of splitting each writing $2 million checks, and then similarly rounding out with some smaller firms
okay.
and enable those. Yeah.
So most of the seed deals, you're sort of in a way splitting the deal. It's not you and then a whole bunch of smaller funds. Would you say that's accurate?
I would say usually it's mostly us as the lead, and then there are smaller funds that are,
Okay,
tucking in as well.
got it.
That it is probably less frequent versus 10 years ago or 5 years ago, us
Yeah.
just splitting in the middle.
There's a reason I'm asking that question, and that's sort of, what's happening in the market and different people having different philosophies. So I'm going to come back to that. But before I do that, just a quick, so on the pre-seed seed, what are you seeing in terms of pricing? I mean, there is a huge inflation going on right now.
Well, I think there's a couple of things going on. There's certainly a have and have nots versus AI versus not AI. And I mean, everyone has positioned themselves to be the former as opposed to the latter, but it's very to varying degrees. Valuations, I think we're seeing post money's pre-seed and 10 to 12, and I believe those are the ones we're doing. And then at the seed, it's kind of 20, low 20s. I mean, we see things get done much higher than that.
Yeah, well, you're staying very disciplined. I've had a couple of folks on this show, and particularly in the Valley, there
Yes.
is amongst early stage investors, like no matter what our strategy, we've got to be in the deals that are most important, and we'll participate in the inflation, and so none of you're resisting that temptation. You're staying disciplined. Right.
Well, and it's a balance, right? Like, there is no subprime in VC. You can't go around trying to invest in the best, the cheapest investments, because that's not a recipe for success. But what I like to tell my partners is that you want to not lose the deal on price, but you don't want to win the deal on price otherwise. Meaning, um, you don't want to lose because you're just systematically bidding lower than every other firm. Like that's not a way to as a strategy. But you don't want to be winning because you have the highest bid every single time. And so I think you have to come in where it's competitive, and then you have to win on the intangibles or things that are other than price. At the end of the day, you want entrepreneurs to choose you and your firm, not just choose your price.
Yeah, my partner Maya has a great saying that has served her well in her 20 plus years, which is price is not a reason to do a deal or not to do a deal.
That is exactly it. I like that. I'll lift that for him, but I'll reference her on it. So
Yeah.
that is absolutely true.
Okay, so let me ask you this: and 5 funds since 2010. How many companies have you guys invested in? Rough ballpark.
Low 220 something. Yeah. And I would say 8 of those matter, or 10 of those
Yeah.
matter. Yeah, it really is a power law, as you might.
It is. It is a power up.
And that's something I knew like up here when we started, but like now
Get
now
out here.
I
It on your stomach now. Yeah. It's intimidating. But particularly sort of if you're doing B2C and B2B2C, right? There, I think the power up probably
yeah, that is much more exceptional.
even more exceptional. Yeah. So just that's a lot of experience, right? And I do believe that this business is ultimately, you have to do this, but you learn the business by doing this business.
I agree.
You got to make money. You learn from making money, and you learn from losing money, right? So 8 to 10 over 200 have sort of returned
Yeah.
the numbers.
Well,
Made the numbers. So just tell me, let's peel that apart a little bit, because I think that's there's so much learning there, and so much learning that founders could have from that.
yes.
Tell me, how many of those 10 were obvious from day one, and how many were not obvious?
I think almost all of them were not obvious at the beginning. I mean, there's a couple where, yeah, you back a repeat founder, and he or she is doing the same thing again, and you're like, okay, well, let's do that. I would say half of them, the ultimate, a couple of things. Generally, I think about half of them, what they initially started out doing, it completely changed. Like Triple F, which I mentioned before, it was started as a Pinterest analytics, and then they ended up being programmatic native advertising. So like completely 180. Um, but half of them were very true to the vision. We talked about Whoop earlier. When Will came in and shared this story next to you, I mean, literally, I think it was 2012. He said, I'm going to do a fitness wearable based on your wrist and start high end. And then it's going to come down to be a mass consumer product. And it's going to be, we're going to start with athletes instead of like everything that has played out over the last, 14 years. That's exactly what he said. But half of the time it's just completely different. And the other thing I would say, coming along the same lines of those themes is, if you ask me in each one of our funds, even 5 years in, which 2 to 3 companies are going to be the value drivers? Even 5 years in, it's not obvious.
I'm so glad you're saying that. My LPs want to know, and even 5, 6 years in, I mean,
I can tell you which ones are completely not going to be the ones that are going to
be the ones. Yes, those are obvious. Those Okay.
Yeah.
So this let's get into the meat of things now. That's just very, very important insight that you have learned. And so how does that inform your decisions going forward? It's not obvious. Even in year 5, 6, it's not obvious. The ones that are not working out,
yes,
okay, sooner perhaps. The ones that are working out, you just can't. There's so many false positives and false negatives in our business, right? It takes a while until you have that rhythm of revenue growth, what have you.
Yeah.
So there is a very important point there, which is, as seed investors, pre-seed investors, a lot of what determines whether it'll graduate to a Series B, let's say, or a C, is product market fit.
Yes.
And today the world has dramatically changed in terms of the different types of investors. There's a whole set of funds that are one and done, right? And they may be on the cap table with you or on the cap table of founder that are and they're very honest about it. We just write one check.
Yeah.
Because of XYZ, right?
Yep.
Or they'll find their way to write one check, whatever.
Yep.
You are a high conviction investor that has bought 5, 10% of the company. Right. You are right there with the
maybe more. Yes.
Maybe 20%, right? So also location. Low teams, right? So you have a lot more skin in the game, which is excellent for the founders, right? An astute founder should really pay attention to that, because,
as I've said, every investment is just that. It's a true investment.
It's a true investment.
Yeah,
it's not an option, right?
Yeah.
It's not an option. Sure. So how, just tease us apart, when, how much patience will you as an investor have, and when to give the founder more time to arrive at product market fit?
So since the beginning of our firm, we've had a very similar portfolio construction approach. It's 10 new investments annually, 3-year investment cycle, 34 investments in each fund, half the capital in the fund for initial investments, half for follow-on. So half of our capital is for follow-on. Part of the reason we build syndicates is to, have like-minded investors, around the table who can contribute. I think there is not an easy, one, crisp answer as to when we continue, when it's a challenging situation, and when we push, the entrepreneur to say, hey, maybe this isn't working out. I think part of it is trying to help empower the entrepreneur and founding team to raise additional capital in addition to ours, even if it is a bridge round, right? And even if we are leading it, can our signal and the entrepreneurs' excitement about what is around the corner, help attract additional capital to ours, even if the original syndicate members aren't, participating as well.
I'm probably an investor that errs more on the side of not giving up. I just feel like this is such a hard business that you should not be getting into it if you're just going to give up quickly, right? So
Yes.
hopefully our filter is good enough, but we don't invest.
I'd agree with you, but maybe say it a different way, which is I think you have to be an optimist in this business, and if you're not an optimist, then you should
you,
go
you,
go.
you have you have to be able to walk through walls. So I guess so on that, just I think what concrete advice would you have when sort of company is they're in year 1, 2, 3 and it's not quite there yet. Like
Yeah.
they should not be expecting you to be a blank check either. That's not fair, right?
No.
And so what concrete advice have you given founders in those situations where things eventually worked out? So let's look at your successes. And it took a while, but what did they do that eventually got them there?
They changed, right? And so I think what I see too often is um, kind of incrementalism. It's like, it's not working, we'll just change these small little things, as opposed to, hey, this is not working. Maybe we not do them to 180 degree change, but we need to change 45 degrees or 60 degrees and try on something that is, meaningfully different. And if that's not working, then we'll go to the next. I've often had entrepreneurs ask, like, do you think we have product market fit? And that is the answer to that question is in the question itself. If you have to ask, then the answer is no. Because when we've seen it, when you have product market fit and it really is there, like it is abundantly obvious, and your problems are lots of other problems. There's other, but they're high class problems. They're not
Right.
the core problem, which we're trying to overcome. We're pre-seed or seed stage investors. Is let's go from having not a product or not anything to let's have product market fit, and that is like the core risk that we as seed stage investors make.
We are underwriting. Correct. I like that. So 45 degrees to 60 degree to even 90-degree shift. Do not be afraid. Like throw your own assumptions out of the window and think with a clean slate, right?
Yes.
And
5 or 10 degree change is not gonna. That's not gonna.
it's not gonna.
It's not working. Like 5 degrees is not gonna. That's not gonna
That's
change.
right.
Oh no.
Yeah, and then manage your burns so that you have time to figure that new strategy out.
Yeah.
Excellent. All right. So let me just maybe shift gears to the current market, which is a very interesting time we are all investing in. So your take on AI, is this just a tech stack shift, or is this something fundamentally different that is changing the way you think about investing?
Well, I've been an entrepreneur and an investor for almost 30 years at this standpoint, and I think about the major waves, which were internet, cloud, mobile. You might put social in there, and then AI. I mean, so it's like one of the top 4 or 5, and I think we are at just the very beginning of what will be a multi-decade shift in technology. But then I think the thing that even we NextView get excited about as well is are the second order effects of how that affects people's lives in many ways, right? It's like you go back to the shift around building highways across the country, and what is the result? It's drive-throughs. Or if you think about, okay, we've got the mobile phone. Who would have thought, when the App Store came out in 2008, I believe mobile phone was 2007. Who would have thought that like the biggest company would be a taxi company, right? And so it's like it's not linear. Right now, I think a lot of what is being kind of invested in, which is good, is you need a lot of this infrastructure layer stuff. But I think to me, the exciting things that are going to come out are those like second order effects. Like now that we have this, what does that mean for how we go through our daily lives? So
So look,
I'm bullish. That's not to say there's like lots of pockets of froth, but like
of course.
I'm long term bullish, and I think if you're investing outside of AI, it's kind of like investing in disk drives in 1996. You might have been able to make money, but not for very long. So
That's right. That's right.
yeah,
True. I think we're all sort of thinking very similarly. So you're not a plumbing investor, right? You're not doing the infrastructure layer, nor are you doing the tooling. You're very much not just application, but also sort of end consumer, right? Large
yeah.
market, large end market. So how are you approaching this current market? Or have you guys placed some bets already at that layer, or are you saying let this plumbing work itself out? We're going to hold our fire, and then we're going to wait for that end market to emerge. How are you approaching
No, I mean I think
investments?
some of the foundation is already being laid, and that you can build application companies. Where it was announced yesterday. Um, a company called Beside that we invested in. They subsequently raised another 20 million after us. But that is basically a AI powered digital assistant for your phone. And so it replaces your business phone number. If you are, for example, if you're a real estate agent, so like all of your calls get transcribed. It will automatically draft follow up emails based on those conversations, et cetera. It's like having an AI assistant literally in your pocket, and you get a dedicated phone line, et cetera, that comes with it. And so like that is just like one end user experience that is being completely reimagined by some of the base, even base level tooling around LLMs, et cetera. That here's a new application that you can build on top of that. And it's been amazing to see just like after that company launched, to just uh the growth that can happen when it really hits. So
Yeah, I mean, it's been interesting. The growth is happening much faster
yes,
uh, in some
it
of
might
these.
not be as durable because we've seen some companies. Yeah,
That's right.
go up.
How durable
Yes,
go up and then come down. How durable is 0 to 118 months?
yeah.
It's a question. We'll see. All right. So, are you approaching these investments any differently than prior, let's say, SaaS investments? How do you think about this?
No, I wouldn't say there's a fundamental difference in how we are approaching kind of either structure or not. I think we are mindful. I think it's, as I said, I think it's a spectrum on how AI enabled something is, and I think we're mindful from a downstream capital raising ability that the closer it is to the white hot center, then they'll maybe at least for the short to medium term might have I'll say easier, less difficult financing challenges. Whereas if you're investing in things that might not be in that white hot center, but you have um, a fundamental belief in the entrepreneur and or the market or the product, then you just have to be mindful about down how you're preserving for those companies as well.
What about sort of founding teams? What are you looking for in teams today? Like what's more
So being, I would use the same line. We use one word internally next to you, and we use the word authentic as to try to describe the founders that we want to back. And I think that means a couple things. I think the first is around experience, meaning it's experience and insight. Do they have the either an experience set that gives them a unique insight as to why they're going to start the company, or an unfair advantage as to why they're starting the company? And so the way I like that frame is it's not measuring experience in years because we back to Whoop, we back to Will. He's literally in his Harvard College dorm room, right? Um, but he had an experience set for some of the things that he did an abundant amount of research on physiology, kind of with heart rate variability, um, and and so it's not measuring experience in years; it's measuring in insights and ability to perform. And then I think there's something also the word authentic, a next to you entrepreneur, carries herself or himself in a way that with integrity, et cetera, that, there's some intangible values there that word tends to encompass as well, which I think we, tend to like to latch on as well.
So when you are evaluating a founder, is it sort of the main founder that is the most important? Is it the team? Who else is on the team? How important, solo founder versus multiple founders? Do you guys have a preference?
Yeah. So of the 200 odd something companies, I think I can think of maybe like three examples where it's literally just a founder as opposed to a founding team. Um, we are majority of the time we are investing pre-product, but the very, very minority of the time is it pre-team, if that makes sense. Um, and I think about it being you want to have folks that are complementary with each other.
Right.
And but I think the other lens we think about evaluating the founding CEO um, is and we tried to look back at the companies that we invested in. Okay, what are the common traits or what are the key traits? Um, and the one that came up the most often was like the capacity and willingness to learn and level up. And so, like, of course, especially when you're investing in first time founders, they're not exceptional. They're not going to have the same um, gravitas that a serial entrepreneur has that's done it three times. That's just not who they are. But it's like, do they have the ability and the desire to be able to level up? I can think of two companies that I've invested in. I had invested actually in a couple developer tools companies, but I can think of one example where the founder he just wanted to build product and it was all just about building product and they just were just shipping product all the time, but they were never thinking about, okay, how do we actually sell this product? And he's just building for himself. And then there's the other one I contrast. He they built the product, then he went and hired, he realized he wasn't the person to sell it, so he hired like a sales leaders. And then, as they were growing, he's like, okay, now I've got a team. I'm going to hire an executive coach so that I can level up. And I'm not saying you need to hire an executive coach to be successful, but it's just emblematic of his desire and his capacity to want to just keep leveling up along the way. And so like that trait we've seen in the founders that have been successful. It's just like they always just want to keep, raising the bar, so to speak.
They're building new muscle
Yeah.
as they're going, right? Very key. So backing a strong athlete that's building new muscle. Agree. How often would you say so? The going back to the 8 to 10 over the 200, is it the founder that took it all the way, or were there changes along the way?
I'd say most of the time it's the founder. Not always, but
Right.
most. Yeah.
And then how often would you say in the 200 sort of a team change occurs? If so, when and why, how? And
It's funny, my partner
about
Stephanie has this shows my partner Stephanie always jokes if there's three founders, there's always one is going to be gone within the first 2 years. Um,
very interesting.
uh,
Interesting. Okay.
the I think there's quite often that the founding team is not the whole team is not there when the company ultimately exits.
But how many times would you say, you brought in what the board or the founder himself says, I'm going to bring in someone else to be CEO?
It happens. I mean, I think you want it to happen out of happiness, not out of pain. I guess I'll be there.
Pain doesn't work.
Pain doesn't work. I mean,
Right.
so I mean, a company I mentioned earlier, a company Attentive, Brian Long took that to a couple hundred million in revenue, and then brought in a new CEO, and that was a very orderly transition that was welcomed all around. Um, I think they're going. a couple cases where we've had new leadership that has come in, and when it's maybe not been the ideal situation, and like I can think of one like there are a couple it doesn't end up working out. I think usually the founder is the one who has to drive it because it's just their vision that they're trying to manifest, and if they're not there to make it happen, it's not going to happen. And it's someone else that's hired to do so.
I'm asking you this question because you're a very experienced investor. You've seen a lot of these stories, and this is often not talked about, right?
Yeah.
But I agree with you. In my experience, the only time that change works is if the founder really wants it, right?
Yes.
Then I mean they have to be around, and they have to want another partner who has a different set of muscles that they don't want to build, or but they see the newcomer as a second half, right? In those
Yes.
situations it works out beautifully. The rest of the time it's painful. It's not happy for anyone. Okay, this is great. Just mindful of your time here. Couple of let's shift gears to our current moment. Any predictions for what where you think the market is going? Types of companies we might see in the next 5-7 years.
Yeah. So in predictions, this is related to the market. I think, and this is it was top of mind because we had our annual meeting last week, and this is one of the talks that I gave. But I think we talked a lot about AI, but I think AI is coming towards to eat us as VCs. I think if you look back at think about other places within equities markets, like if you asked a mutual fund manager in 1995 if computers were going to take his or her job, they would probably laugh. And then fast forward 30 years, and 80% of trading in public equities now is done completely through computational power and algorithmic trading. And what I think is interesting is that it's not 100%. It's 80%. There is still a human element to public equities market. I think there will always be a human element to VC market, but I think increasingly AI is going to take up in a lot of the functions of venture firm, and something we're very mindful of, that we have to reinvent ourselves over the next 10 years.
Okay, so AI will eat VC, and
Yeah.
VC will turn into algorithmic or AI trading.
AI assisted. Yes.
AI assisted. Okay, so which is a great segue to, there is one thing that you want to automate today using the AI tools available in your day-to-day job. What would that be?
Would be there are tools out there, and I experienced many of them, which is just digging myself out of the email inbox. So
Get me out of my email inbox, okay? Petrol. All right. AI is going to eat our jobs and do our jobs in 10 years. So hopefully we'll all have retired by then. But
sounds like a planned event.
sounds like a plan before we all become farmers. What are you excited about in terms of sort of the power of the technology in terms of the positive that can happen? Any particular sort of predictions on?
Yeah, I mean, I spend a lot of time, as I said, in marketing and commerce, and like I just think how we shop for things is going to absolutely change. And um, you can catch glimpses of it today, even as a consumer, when you're interacting with ChatGPT or Claude or whatever you use. Um, but I think about like if you go to a product page on a website, it's like the same product page that Amazon had for selling a book 30 years ago. And like, it seems to me that, there's lots of things that are going to change about how you shop online, especially for high consideration goods. Which I think it's going to be much more personalized. I think to me, that's quite exciting. No,
Quite
that's not completely changing the world. My partner, Rob, who does a lot of digital health, will tell you how AI is going to, help deliver better healthcare to people across the world. And that's even better, but that's not my domain expertise.
Yeah, yeah. Well, I hope to speak to him soon. Okay, as a parting advice to a first-time founder starting a company, what would one piece of very concrete advice to them be? Not passion, courage, commitment, all that stuff, right? But sort of something concrete that they can act upon.
All for fundraising, because that's what I know. I would say to go back for fundraising, all investors make decisions here, not here. And so, and I think that's whether you're an angel investor, whether you're a seed stage investor, I think that's the same if you're a growth stage investor. Like you gather all the facts with your head, but ultimately the decision is made with people's hearts. And so what that means for fundraising is you can present the facts, but I think you have to wrap it in a story that that pulls people emotionally somewhere. And so part of the fundraising process is finding those believers who can not just understand what you're doing from an intellectual standpoint, but kind of believe what you're doing from their heart.
And those are the founders who raise money successfully, also go the distance. Yes, that's right.
Yeah,
Excellent.
we want to be able to weave a tale for sure. Yes.
That's right. That's right. Excellent advice, David. Well, on that, thank you so much for taking time from your busy day and having this conversation. I've learned a lot. And you remain my go-to person for B2B2C questions and advice. So,
Thank you. Awesome.
okay. All right. Great seeing you.
Good.
Bye-bye.
See you.
Bye-bye.